Common stock investment, things to consider. Investing in common stocks in the U.S. stock market presents both opportunities and risks. Investors must follow certain rules and best practices to successfully navigate this landscape. Here's a breakdown of the basics. 1. Regulatory oversight and compliance. Securities and Exchange Commission, SEC. The SEC is the primary regulatory agency that oversees the U.S. stock market. Investors must ensure that brokerage firms and all investment vehicles they use comply with SEC regulations. Financial Industry Regulatory Authority, FINRA. FINRA is a self-regulatory organization that also plays a key role in investor protection. It's essential to understand the rules and guidelines set by these organizations. 2. Due diligence and research. Company fundamentals. Before investing in any stock, conduct thorough research on the company's financial health, including its earnings, revenue, and debt levels. Industry analysis. Analyze the industry in which the company operates, its growth potential, and the competitive landscape. Risk assessment. Assess the risks associated with investing, including market volatility, industry-specific risks, and company-specific risks. Financial reports. Investors should be able to read and analyze the financial reports of companies they want to invest in. 3. Brokerage and trading practices. Brokerage selection. Choose a reputable brokerage firm that offers competitive fees, reliable trading platforms, and access to research and analysis tools. Order types. Learn the different order types, such as market orders, limit orders, and stop-loss orders, to manage risk and execute trades effectively. Day trading rules. Be aware of day trading rules, especially the model day trader definition, which applies to investors who execute 4 or more day trades in a 5-day period. Pre-market and post-market trading. Understand the risks and characteristics of trading outside of normal market hours. 4. Diversification and risk management. Diversification. Spread your investments across different sectors and asset classes to reduce risk. Asset allocation. Determine an appropriate asset allocation strategy based on your risk tolerance and investment goals. Risk tolerance. Understanding your risk tolerance is key. How much of your investment can you afford to lose? Long-term perspective. Adopt a long-term investment horizon to withstand market volatility and maximize returns. 5. Tax implications, capital gains. Taxes. Understand the tax implications of capital gains and losses and consider strategies to minimize your tax burden. Dividend taxes. Be aware of the tax treatment of dividends, which can vary depending on your income level. Key points: market volatility. The U.S. stock market can be quite volatile, and investors should be prepared for potential losses. Sources of information. Rely on reliable sources of information, such as SEC filings, reputable financial news sources, and independent research reports. Professional advice. Consider seeking advice from a qualified financial advisor to develop a personalized investment strategy. By following these guidelines, investors can increase their chances of success in the U.S. stock market while minimizing potential risks. Warning: investing in the stock market is risky. Be sure to do your own research and consult with a financial advisor before investing. This information is not intended as investment advice. The author and publisher are not responsible for any losses incurred.